So we're actually a little bit pessimistic here, I think, relative to where the market is. So we have written down about a $450 billion package that comes in Q1 of next year. So we've assumed that there's no more fiscal policy in calendar year 2020. And then by the time we get to the beginning of next year, we assume that a slimmed down version of what has been the Senate Republican plan, so about $450 billion. My sense, talking with clients globally, is that the market is probably expecting something closer to $1 trillion. So it would take a real outperformance relative to my expectations for it to be an upside risk to the market. Now, I will say our number of 450 assumes that the Senate remains in Republican hands on the possibly unlikely chance that the Democrats get control of the Senate. Then I think you might be looking at roughly twice that, so not quite $1 trillion. So you would really need the Democrats to take the Senate to ratify market expectations, I think.
And certainly it's something that the Fed have been quite vocal about. We heard from Chairman Powell last week, and he emphasized yet again that he would like to see more done on the fiscal stimulus front. In the absence of that, people are expecting the Fed to provide even more stimulus come the December meeting. What do you think the Fed can do here? What more tools do they have in their toolbox to sort of tide the economy over into next year?
That I think is the tricky question right now. So Powell and in fact central bankers globally before the COVID shock were clamoring for more fiscal policy, and then the COVID shock only made those cries that much more clarion. And I think part of the reason is that the number of tools left for the Fed are actually quite limited. So the Fed has got short-term interest rates to zero. They've ruled out negative interest rates. They promised to keep interest rates at zero for as long as they possibly can until inflation comes back. So that tool is exhausted. Their special lending facilities, they've sort of declared victory by virtue of there not actually having been much take-up. So those tools seem like they're exhausted. And so all they have left are their asset purchases, the QE purchases. And there, to provide just a bit more accommodation, I think they take those purchases where right now they're buying from 2-year securities out to 30-year securities, and they focus those purchases just at the long end of the curve, so from 5 years and longer, to try to put a little bit more downward pressure on longer-term yields. We have seen the 10-year yield pop up. It had been down in the 60s. Now it's just shy of 1%. So at the margin, they could probably provide just a bit more accommodation that way.
One of the other things that emerged this week is the news of a potential breakthrough in a vaccination that's been met with euphoria by markets and with everyone alike, really. I think all of us want to see the end of this pandemic. What does that breakthrough mean for your forecasts, and how does the rollout of the vaccination affect the trajectory of the U.S. economy in 2021?
Key question. So the two biggest uncertainties coming into the fourth quarter were what was going to happen with the election and what was going to happen with the virus and the vaccines. I think the news from Pfizer was very encouraging. The 90+% efficacy rate very much exceeded at least our analysts' expectation for where efficacy was going to go. And it gives you this possibility for an early vaccine scenario. So what we said was, under the baseline, things take time, there are setbacks, efficacy rates might be in the 50 to 60% rate. Under that scenario, reported COVID cases in the United States probably don't fall to zero or close to zero until the fourth quarter of 2021. The news this week says there's a different path. We might get a situation where reported cases of COVID in the United States fall very close to zero in Q2 of next year. That 6-month difference, that 2-quarter difference matters a lot. It means an extra 1 to 1.25 percentage point gain in GDP next year. To put that into complete numbers, under our baseline view for a President Biden with a split Congress scenario, we're looking at something like 2.75% growth next year. If everything goes right and Pfizer's results are indicative of where we're going, that number could actually be more like 4%. So it really will be a bit of a game changer.
Right. So huge upside there. But again, looking at it from another angle, if you look at the labor market situation right now in the US, at the peak of the pandemic, about 22 million jobs were lost. Half of those have been recuperated. It's probably going to take quite a long time for people who are now unemployed to find jobs again. My question to you is, do you think that the pandemic has structurally changed the composition of the US labor market forever now?
Yeah. So that's possible, but you're absolutely right. Things are depressed, and in particular, employment is depressed in the services sector, which is why it's so critically important what happens with the vaccine, because that's the sector that's going to recover if we have a vaccine. If you took October job creation and just extrapolated that through time, it would take until the beginning of 2022 before we get back to pre-pandemic levels of employment. So it really is a very long-lived phenomenon. Has it structurally changed things so that we're never going back? I think that's possible. What we saw after the last recession, after the financial crisis, was that labor force participation, people's willingness to go out and look for a job, fell from 2008 until 2015. So 7 years, I guess, isn't technically forever, but it's closing in on it. And this shock was clearly much more disruptive. So I think there's the chance we get a fundamental shift in employment. We've seen a big change in the way people buy physical goods, a big jump in how many are online. That really does mean that longer term trend that we had been seeing to shopping online got accelerated. And I think those sorts of retail sector jobs could easily be going away much more quickly than they had been pre-pandemic.